China has made a decision that is reshaping global commodity markets and redefining who sets prices for the metals that power modern civilization. Beginning in January 2026, Beijing activated export restrictions on refined silver, while simultaneously locking in multi-year forward contracts for copper, aluminum, and other strategic metals through the Shanghai Futures Exchange. On December 25, 2025, Shanghai copper breached 100,000 yuan per ton for the first time in history. Shanghai silver futures climbed to over 14,000 yuan per kilogram, nearly double their year-ago level. What's happening behind this decision is not merely a trade policy adjustment, but a calculated seizure of commodity pricing power from Western exchanges. This move represents the largest structural shift in metals markets since the London Metal Exchange dominated global pricing in the 19th century. For 70 years, the world's commodity prices were set in London and New York, denominated in dollars, governed by Western financial institutions. China consumes over 50% of global copper, aluminum, and zinc. It refines 60 to 70% of the world's silver. Yet until now, Chinese buyers paid prices determined thousands of miles away by exchanges they didn't control. That era is ending. The implications extend far beyond metals markets themselves. When Shanghai sets the real price for physical copper, aluminum, and silver, it's not just challenging COMEX and the London Metal Exchange. It's undermining the dollar's role as the universal pricing mechanism for commodities. This shift affects everything from electric vehicle production costs to solar panel economics to the leverage Western governments hold through financial sanctions. But first, we need to understand how this pricing monopoly was constructed and why it persisted for so long. To understand why this moment is so crucial, we must go back to the post-World War II financial architecture that established dollar dominance in global commodity markets. When the Bretton Woods Agreement was signed in 1944, it created more than just a new monetary system. It embedded the US dollar as the mandatory medium for international commodity trade. The London Metal Exchange, founded in 1877, became the primary price-setting venue for industrial metals. Later, the New York Commodity Exchange, known as COMEX, emerged as the dominant force in precious metals pricing. Both operated in dollars, with settlement through Western banking systems, creating a self-reinforcing cycle where commodity producers and consumers had no alternative but to accept Western price discovery mechanisms. This system granted enormous geopolitical leverage to the United States and its allies. Oil, the most strategic commodity, was priced exclusively in dollars through benchmarks like West Texas Intermediate and Brent crude, both controlled by Western financial institutions. When countries purchased oil, copper, or wheat, they first had to acquire dollars, creating permanent demand for U.S. currency. This demand allowed the United States to run persistent trade deficits without facing currency crises that would devastate other nations. The exorbitant privilege, as French Finance Minister Valéry Giscard d'Estaing termed it in the 1960s, meant America could print money to pay for imports while the rest of the world absorbed the inflation. The pricing mechanism itself became a tool of control. Futures contracts on COMEX and the LME determined not just current prices, but expectations for years ahead. Producers in Chile, Peru, and Australia sold copper based on LME benchmarks. Manufacturers in China, Japan, and Germany bought based on those same benchmarks. The exchanges collected detailed information about supply, demand, and inventory levels worldwide, giving Western financial institutions asymmetric information advantages. More importantly, the U.S. government could weaponize this architecture. Sanctions against Iran, Russia, or Venezuela didn't just block those countries from dollar transactions. They effectively cut sanctioned entities out of global commodity markets because contracts couldn't be settled, insurance couldn't be obtained, and shipping couldn't be financed without access to dollar-denominated financial systems. China emerged as the world's largest commodity consumer during its industrialization from 1980 to 2020. By 2010, China consumed more copper than the United States, Europe, and Japan combined. Yet Chinese buyers remained price takers, not price makers. When a Chinese manufacturer needed copper, they checked the LME price, added transport and financing costs, and paid whatever the market demanded. Shanghai had its own futures exchange, the SHEF, established in 1992, but trading volumes remained modest, and prices simply tracked London and New York with slight premiums or discounts based on local supply conditions. For decades, this system seemed unshakable. Western financial institutions profited from intermediating commodity trades. The dollar remained the undisputed global reserve currency. Developing countries complained about the inequity, but lacked the market power or financial infrastructure to offer alternatives. But something changed in the past 5 years, and those changes accelerated dramatically in late 2025. The breaking point came from multiple directions simultaneously. First, China recognized that whoever controls physical metal controls pricing, not whoever operates the most sophisticated financial derivatives markets. Second, geopolitical tensions with the United States convinced Beijing that reliance on Western-controlled commodity infrastructure represented a strategic vulnerability. Third, technological advancement in Chinese financial markets reached the point where Shanghai could offer credible alternatives to London and New York for international traders. Fourth, and perhaps most importantly, China implemented policies encouraging domestic entities to hold physical metal assets instead of dollar-denominated financial assets, fundamentally altering supply and demand dynamics in global markets. The evidence of this strategic shift became undeniable in the final months of 2025 and the opening days of 2026. Let's examine exactly what happened, why it happened, and what it means for the global economic order. In December 2025, trading volumes on the Shanghai Futures Exchange reached levels that stunned market analysts worldwide. Base metals turnover hit 37.1 trillion yuan, approximately $5 trillion in a single month. That represents a 260% increase compared to December 2024. To put that in perspective, the entire annual turnover of the London Metal Exchange typically ranges between $3 and $4 trillion. Shanghai processed more than that in just 1 month across its copper, aluminum, zinc, nickel, lead, tin, silver, and gold contracts. This wasn't speculative froth. Physical delivery volumes surged alongside financial trading. Unlike COMEX, where less than 1% of contracts typically result in physical delivery, the Shanghai Futures Exchange deals primarily with participants who intend to take or make delivery of actual metal. Reports from early January 2026 indicate physical silver flowing out of Shanghai Exchange warehouses at record levels as manufacturers and investors took possession rather than rolling contracts forward. This represents real demand for real metal, not paper speculation. The pricing impact was immediate and dramatic. Shanghai copper contracts breached 100,000 yuan per ton on December 30th, 2025, a psychological and technical barrier that triggered massive attention from global market participants. At the same time, LME copper lagged behind, creating persistent price divergence. Traditionally, arbitrage traders would quickly eliminate such gaps by buying the cheaper metal in London and selling the more expensive metal in Shanghai. But that arbitrage broke down because physical metal couldn't move fast enough to close the spread, and more importantly, because Chinese buyers were willing to pay premiums for yuan-denominated, Shanghai cleared contracts rather than accept dollar-denominated. Western cleared contracts, even at lower nominal prices. Silver told an even more dramatic story. China implemented new export restrictions on refined silver effective January 1st, 2026. Under the new rules, only large, state-approved companies with annual silver production capacity exceeding 80 tons and credit lines above $30 million can export silver from China. This policy effectively locked out hundreds of small and mid-sized exporters who previously supplied global markets. China refines an estimated 60 to 70% of global silver supply, meaning these restrictions instantly created a physical shortage in Western markets. The impact on pricing was explosive. COMEX silver prices in New York surged above $76 per ounce by late December, but Shanghai premiums over COMEX exceeded $8 per ounce throughout the period. In other words, buyers in China were paying $8 more per ounce than buyers in New York, even though China is the major producing and refining center. This price inversion indicates Chinese domestic buyers anticipated being unable to access metal at any price if they didn't secure supply immediately, regardless of cost. Physical silver shortages in Shanghai grew so severe that analysts warned of potential force majeure declarations if exchange warehouse stocks fell below critical thresholds needed to settle outstanding contracts. Behind these visible market moves lay a much larger strategic shift. China has been implementing policies since early 2025 to encourage holding physical metal assets rather than dollar-denominated financial assets. Official statements from the Chinese government in March 2025 announced plans to add copper and cobalt to state strategic reserves, joining existing stockpiles of oil, grain, and other commodities. Industry analysts estimate China's strategic reserves of copper and nickel are already 35 to 133% of annual domestic demand, representing months or even years of consumption held in government warehouses. This stockpiling extends beyond official reserves. Chinese banks and state-owned enterprises have been systematically purchasing physical, copper, aluminum, and silver for investment purposes, treating metals as stores of value comparable to gold. The rationale is straightforward. Holding dollars or dollar-denominated bonds exposes Chinese entities to currency risk, inflation risk, and sanctions risk. The United States froze hundreds of billions in Russian foreign exchange reserves in 2022, demonstrating that dollar assets held in Western financial institutions can be seized at any time for geopolitical reasons. Physical metal stored in China faces none of those risks. It has intrinsic value, industrial demand, and cannot be confiscated by foreign governments. The forward buying strategy represents the culmination of this approach. Rather than purchasing metal spot or on short-dated futures contracts, Chinese buyers have been locking in supply through long-dated forward contracts extending into 2026, 2027, and beyond. These aren't financial derivatives. They're agreements for physical delivery of actual copper, aluminum, and other metals at specified future dates. By securing multi-year supply commitments now, China ensures its manufacturers have guaranteed access to raw materials regardless of future price spikes, supply disruptions, or geopolitical conflicts that might otherwise restrict access. Why is this happening now? The timing is not coincidental. Multiple factors converged in late 2025 to create the conditions for China's commodity market power play. First, the economic rationale became overwhelming. China's Belt and Road Initiative, announced in 2013, has created massive infrastructure projects across Asia, Africa, and Latin America, requiring enormous quantities of copper, aluminum, steel, and cement. The clean energy transition, accelerated by climate commitments, demands even more metals. Every solar panel requires approximately 20 grams of silver. Every electric vehicle needs 25 to 50 grams of silver, plus substantial quantities of copper for wiring and motors. Wind turbines, battery storage systems, and grid upgrades all consume massive amounts of industrial metals. China leads the world in solar panel production, electric vehicle manufacturing, and wind turbine installation. Securing metal supply at predictable prices became a strategic imperative for maintaining industrial competitiveness. Second, supply constraints intensified throughout 2025. Major copper mines in Chile and Peru faced production disruptions due to labor strikes, water shortages, and declining ore grades. The copper market entered a structural supply deficit, meaning global consumption exceeded production even before China's accelerated buying. Analysts at Goldman Sachs and other investment banks warned of copper shortages extending through 2029, with prices potentially reaching $6 per pound or higher. For China, waiting meant paying exponentially higher prices later or facing actual shortages that could halt production lines in strategic industries. Forward buying at 2025 prices, even at premiums, makes economic sense compared to spot buying at 2027 prices that could be 50 to 100% higher. Third, geopolitical calculations shifted dramatically. The United States, under various administrations, has increasingly used sanctions, tariffs, and export controls as foreign policy tools. In 2022, Washington froze Russian central bank reserves. In 2023 and 2024, the U.S. expanded semiconductor sanctions against China and pressured allies to restrict technology transfers. Beijing observed these actions and concluded that dependence on Western-controlled systems, whether financial markets or commodity exchanges, represented unacceptable vulnerability. The dollar, once seen as a neutral medium of exchange, was now viewed as a weapon that could be turned against China at any moment. Building alternative systems became a strategic priority, not just an economic preference. Fourth, the domestic policy environment in China shifted to favor physical assets over financial assets. Chinese authorities have been concerned about capital outflows and yuan depreciation for years. By encouraging citizens, corporations, and state entities to hold physical metals, the government achieves multiple objectives simultaneously. It reduces demand for dollars and dollar assets, supporting the yuan exchange rate. It creates domestic demand for commodities, supporting prices and employment in mining and refining sectors. It builds strategic reserves that enhance national security. And it gradually shifts the center of gravity in global commodity markets from west to east. The hidden dimension that traditional media largely ignored is the coordinated nature of China's approach. This isn't a random buying spree driven by speculative fever. It's a systematic, state-directed strategy executed across multiple government agencies, state-owned enterprises, and financial institutions simultaneously. Consider the architecture being constructed. The Shanghai Futures Exchange announced in May 2025 a comprehensive overhaul designed to attract international participants. Under the new framework, overseas investors can post foreign currency as collateral for yuan-denominated trades, eliminating the need to convert everything to yuan up front. This reduces currency risk for international traders and makes Shanghai contracts more accessible. The exchange also standardized contract specifications and warehouse systems to meet international standards, addressing long-standing complaints from foreign participants about opacity and regulatory uncertainty. Simultaneously, China has been negotiating bilateral trade agreements with major commodity producers to settle transactions in yuan rather than dollars. Russia, facing Western sanctions, now sells significant oil and gas volumes to China in yuan. Saudi Arabia, historically America's closest Middle Eastern ally, has conducted yuan-denominated oil transactions with China since 2022. Brazil, the world's second-largest iron ore exporter, has discussed yuan settlement for exports to China. These bilateral arrangements create parallel infrastructure outside the dollar system, gradually building liquidity and acceptance for yuan-denominated commodity contracts. The financial architecture extends beyond exchanges and bilateral deals. Chinese banks have established yuan clearing facilities in London, Frankfurt, Singapore, and other financial centers. The cross-border interbank payment system, known as CIPS and launched in 2015, offers an alternative to SWIFT for international yuan transactions. While CIPS still handles far less volume than SWIFT, it provides a sanctions-resistant option for countries and companies that want to trade with China without exposure to U.S. financial oversight. As yuan-denominated commodity trading grows, CIPS usage grows in parallel, creating network effects that could eventually challenge SWIFT's monopoly position. Behind closed doors, Chinese officials have been coordinating with other commodity-importing nations to promote alternative pricing mechanisms. Japan, South Korea, and India, all major commodity importers, share China's interest in breaking Western pricing dominance, even if they compete with China in other areas. The BRICS grouping, Brazil, Russia, India, China, and South Africa, has explicitly discussed creating commodity pricing benchmarks and settlement systems independent of Western control. While concrete progress has been slow, the intention is clear, and China's unilateral moves in late 2025 may catalyze broader cooperation. What mainstream analysts missed is the connection between commodity market restructuring and yuan internationalization. These are not separate initiatives. They are two components of a single grand strategy to reduce dollar dependence and increase Chinese economic autonomy. When copper trades in yuan on the Shanghai Exchange, Chinese buyers don't need dollars. When Saudi Arabia accepts yuan for oil, Chinese importers don't need dollars. When African countries receive yuan loans for infrastructure projects and repay them by exporting commodities priced in yuan, nobody in the transaction chain needs dollars. Each yuan-denominated transaction represents a small reduction in global dollar demand, and millions of small reductions accumulate into a significant structural shift. The scale becomes clear when examining actual numbers. Foreign holdings of yuan-denominated assets reached 10.42 trillion yuan at the end of the third quarter, 2025, a 43-month high. The yuan ranked fourth in global payment systems by the end of 2024, behind the dollar, euro, and British pound, but ahead of the Japanese yen. More importantly, the trajectory is upward. While dollar share has gradually declined from 96% of global foreign exchange reserves in 1999 to approximately 58% in 2025. The shift is slow but directional, and events like China's commodity market power play accelerate the process. At this point, I need to step back from emotion and look at this through a realist lens. In international relations theory, states act according to their material interests within an anarchic system where no higher authority enforces rules. Power is the currency of international politics, and states constantly maneuver to maximize their security and autonomy. From this perspective, China's actions are not aggressive or destabilizing. They are rational responses to structural incentives. China depends on imported copper, oil, iron ore, and other commodities to sustain its economy. For decades, it paid for those commodities in dollars at prices set by Western exchanges. This arrangement worked when China was weak and had no alternatives. But as China grew into the world's largest trader and second largest economy, continuing to accept price taker status became economically irrational and strategically dangerous. The United States created the vulnerability by weaponizing the dollar and the financial systems built around it. When Washington freezes foreign reserves, blocks SWIFT access, and sanctions entire countries out of commodity markets, it signals to every other nation that reliance on dollar systems is a strategic liability. Rational actors respond by building alternatives, which is exactly what China has done. Furthermore, China's approach leverages its genuine market power. It's not creating artificial demand or manipulating prices through financial tricks. China really does consume half of global copper production. Its manufacturers really do need those metals for production. Its government really does want strategic reserves for national security purposes. When a buyer that large decides to secure long-term supply commitments and insists on pricing in its own currency through its own exchanges, that's not market manipulation. That's market power being used rationally. The West's discomfort stems not from China breaking rules, but from China changing rules that previously favored Western interests. For 70 years, the rules said commodities trade in dollars on Western exchanges. That arrangement benefited dollar holders and Western financial institutions enormously. Now China is proposing different rules. Commodities trade in yuan on Shanghai exchanges, and that arrangement benefits yuan holders and Chinese institutions. From a power politics perspective, there's nothing illegitimate about this. It's simply the natural result of shifting economic weight translating into shifting institutional power. Other major commodity importers face similar incentives. Japan, Korea, India, and European nations also pay for commodities in dollars at Western set prices. They also face currency risk and sanctions exposure. If China successfully demonstrates that yuan-denominated, Shanghai-priced commodity trading works reliably and offers advantages like lower transaction costs and reduced geopolitical risk, rational actors in Tokyo, Seoul, Mumbai, and Berlin will start using those mechanisms too, regardless of what Washington prefers. This is how hegemonic transitions happen, not through military conquest, but through gradual migration toward new centers of economic gravity and institutional architecture. The realist framework also explains why this shift was inevitable, regardless of specific policy decisions. As China industrialized and became the marginal consumer of most industrial commodities, pricing power would naturally gravitate toward Chinese markets. The only question was timing and mechanism. China's government accelerated the process through strategic policy, but the underlying drivers were structural and would have manifested eventually even without deliberate state intervention. Markets tend toward equilibrium, where the largest and most active participants hold the most influence over price formation. China is simply bringing commodity markets into alignment with underlying economic realities. This isn't just about China or commodities. What we're witnessing is the transition from a unipolar world order, where the United States set rules and other nations adapted, to a multipolar world order, where multiple power centers negotiate arrangements that reflect their respective weights in the global economy. That transition was always going to be disruptive because the incumbent hegemon has every incentive to preserve existing arrangements, while rising powers have every incentive to change them. The commodity market restructuring is one theater in this larger systemic transformation. The implications extend far beyond Shanghai warehouse receipts and copper futures contracts. Let's examine what this shift means for economies, consumers, companies, and countries around the world. For the United States, loss of commodity pricing power represents a direct threat to dollar dominance. If major commodities trade in yuan instead of dollars, global demand for dollars declines. Lower dollar demand means downward pressure on the currency's value, which translates to higher import costs for American consumers and companies. The United States has run trade deficits for decades, importing more than it exports, because foreign entities needed dollars to buy oil and other commodities. If that structural demand weakens, the U.S. can no longer run large deficits without facing currency crises. This forces painful adjustment, either through reduced consumption, increased exports which require manufacturing investment and time, or inflation from currency depreciation. The geopolitical implications are equally significant. Financial sanctions have been America's preferred tool for punishing adversaries without resorting to military force. But sanctions only work if target countries need access to dollar-denominated financial systems. If Russia, Iran, Venezuela, and other sanctioned nations can buy and sell commodities in yuan through Shanghai markets, U.S. sanctions lose much of their bite. This reduces American geopolitical leverage and forces Washington to rely more on traditional diplomatic and military tools, both of which are more costly and less flexible than financial pressure. For Europe and Japan, the situation is complex. On one hand, they share America's interest in maintaining Western institutional dominance. On the other hand, they are commodity importers like China and face similar incentives to diversify away from dollar dependence, especially as U.S. policy becomes increasingly unilateral and unpredictable. If yuan-denominated commodity trading offers real advantages, European and Japanese companies will use it, regardless of geopolitical alignment. This creates tension between strategic partnerships with the United States and economic self-interest. For commodity-producing nations in Latin America, Africa, and Australia, China's rise offers negotiating leverage. Previously, producers had to accept prices set by LME and COMEX. Now they can play Western and Chinese buyers against each other, extracting better terms. Countries like Chile, Peru, Brazil, and Australia have already increased their economic integration with China. If Shanghai offers credible price discovery and transparent markets, producers may increasingly orient toward Asian markets rather than Western markets, accelerating the geographic and institutional shift. For individual consumers and businesses, the impact will manifest through prices and availability. If China corners physical supply by locking in forward contracts, Western buyers face tighter markets and higher prices. The solar industry in Europe and the United States already struggles with silver shortages due to China's export restrictions. Copper shortages could constrain electric vehicle production and grid infrastructure projects. In the near term, this means inflation in green technology costs, potentially slowing the energy transition. In the longer term, it creates incentives for Western countries to develop domestic mining and refining capacity, but that takes years or decades to build. Financial markets face volatility and dislocation. Traders who assume prices will converge across exchanges find arbitrage opportunities disappearing. Hedge funds and investment banks that profited from intermediating commodity flows face shrinking margins. Physical commodity traders gain advantage over financial players because, ultimately, access to real metal matters more than sophisticated derivatives, strategies, when underlying markets are tight. This represents a shift from financialized commodity markets dominated by banks and funds back toward physical markets dominated by producers, consumers, and governments with strategic stockpiles. Currency markets will experience significant turbulence. If dollar demand weakens due to reduced commodity-related usage, the dollar declines relative to other currencies. This creates winners and losers. Dollar weakness helps U.S. exporters and hurts U.S. importers. It helps foreign holders of dollar-denominated debt repay their obligations, but creates losses for foreign holders of dollar assets. Given that global dollar-denominated debt exceeds $10 trillion, currency movements of even 10 to 20% create massive wealth transfers between nations. The long-term trajectory points toward a multipolar commodity pricing regime. Shanghai will dominate pricing for metals consumed primarily in Asia. London and New York will retain influence over markets where Western consumption remains significant. Regional exchanges in other parts of the world may develop their own contracts, serving local markets. This fragmentation increases complexity for global companies, but reduces concentration risk. No single exchange or country holds absolute pricing power, making the system more resilient but less efficient. China has demonstrated that the unipolar moment is ending, and the structures that sustained it are vulnerable to challenge. What we're witnessing is not China disrupting markets through unfair practices, but China using its legitimate market power to reshape institutions in its favor, exactly as the United States did after 1945. The difference is that America was constructing a new order after devastating global war, while China is restructuring an existing order without military conflict. This makes the transition harder to perceive, but no less fundamental. The forward contracts China is locking in today represent more than supply security for 2026 and 2027. They represent the physical foundation for sustained pricing power. When Shanghai holds the metal, Shanghai sets the price. Western exchanges can offer whatever derivatives contracts they want, but if the underlying physical market is tight and China controls available supply, those derivatives become disconnected from reality. Pricing power flows to whoever controls physical inventory, and China has been systematically accumulating that inventory for years, while Western analysts focused on financial indicators. The domestic policy favoring metal assets over dollar assets is equally strategic. By creating internal demand for physical commodities, China provides floor support for prices and ensures liquidity in Shanghai markets. This makes yuan-denominated contracts more attractive to international participants because they know there's always a deep pool of Chinese buyers providing stable demand. The Shanghai Futures Exchange recorded 37 trillion yuan in turnover during December 2025, precisely because domestic Chinese institutional investors and manufacturers are active participants, not just speculators, as John Mearsheimer and other realist scholars have observed. When a rising power approaches parity with a dominant power, conflict becomes likely because the rising power seeks to reshape rules and institutions to reflect its growing strength, while the dominant power resists changes that undermine its position. China's commodity market restructuring is exactly this dynamic playing out in economic rather than military terms. The question is not whether the United States will resist. It already is through attempts to restrict Chinese access to technology and resources, but whether that resistance will succeed or merely accelerate China's efforts to build independent systems. This move marks the beginning of a new chapter in global economic history. For 70 years, commodity markets operated as an extension of American power, denominated in dollars, governed by Western institutions, serving Western interests first and global interests second. That era is ending. The unipolar world is fragmenting, and China is positioning itself as the center of gravity for commodity markets that matter most to the 21st century economy, the metals that power clean energy and digital technology. The structural shift is not reversible without fundamental changes in underlying economic realities. China will remain the largest consumer of copper, aluminum, and most other industrial metals for decades. Its manufacturers will continue producing the majority of global solar panels, electric vehicles, and electronics. Unless Western countries dramatically rebuild domestic manufacturing capacity and reduce dependence on Chinese supply chains, which would take a generation and immense capital investment, they will have to accept Chinese influence over commodity pricing as the new normal. For investors, policymakers, and business leaders, the lesson is clear. The institutions that governed global commerce for the past 70 years are being challenged and reformed. Those who adapt to the new multipolar reality will thrive. Those who assume American dominance is permanent and unchallenged will find themselves on the wrong side of history's largest economic transition. China is not asking permission to restructure commodity markets. It is simply doing it, one forward contract at a time, one yuan-denominated trade at a time, one warehouse receipt at a time. By the time Western policymakers fully grasp what has happened, the transition may already be complete.